what are some red flags that people who are thinking about buying should be just extra careful about? And then maybe we'll share a couple of case studies or examples of things we've seen.
Yeah, that's a great question. I think one would be where it's a hurried sale and there's the idea that there's other invisible buyers and the process is murky. That's probably one. Where there is a combined property and business sale and the individual value of either is unclear or not verified by other sources. Not having multiple years worth of financials is something that would concern me because it suggests that they may have been reshaped. Being encouraged to use the same accountant / legal person that is part of the sale would also be a red flag for me. One thing I think, a question they should ask themselves is, given that I was able to start up near this practice, how long would it take me to build this thing of this value and how much would it cost me? So when you're buying a business, often people forget that they're really buying time. They're front loading it. So if you think, geez, this would take me $1 million and 5 years to achieve, then it has a value of beyond $1 million because you're buying that 5 years. That's what you're actually buying, as well as the income stream, which is needed to fund the loan.
Welcome, Todd.
Hey, Sachin, good to see you.
Yeah, you too. And so today, this is inspired by many conversations, but one that you've had recently, this episode. And so buying a practice is something that many GPs in particular will consider in their career, and a proportion of those will follow through and actually execute on that. But many will consider it and be thinking about, what should I do? Where are the pitfalls? It's a great opportunity. I should go about it. So I thought you and I just had a quick chat before, and we thought there's sort of 5 big areas to probably be thinking about. So I suppose at the end of the day, when you're going to buy a practice, the first thing that you're probably thinking about, even though it might not be the most useful thing to be thinking about, but the first thing we think about is, how much is it and what's a good deal? So maybe let's talk about valuation, price, what you're buying. Maybe talk us through that, Todd.
Yeah, I think this is really a really important point because it's often overlooked by buyers. So what you're really buying is a reliable future income stream. I mean, ultimately, if you just think about it as buying shares in a publicly listed company, that's what you're buying. The odds that they'll be around and paying the same or more dividends in the future, that's how you're going to fund the investment. And buying your own business should really be the same mindset. And so there are some things that we see the other side of that absolutely stun me. And I'm going to be really honest, Sachin, they piss me off because they do set people back a decade or more because they get scammed, and they're usually scammed by professionals that probably shouldn't be professionals, and banks that are happy to fund anything because they've got your backside on the line for the next 20 years paying that loan off. They don't really care whether you get a return or not from that, unfortunately.
Yeah, so we've seen situations where, I can think of a situation last year, you'll probably remember, we were at the masterclass before the Practice Owners Conference. We were in a room, I was talking to someone there who's super excited, they're about to buy a practice, and the situation was this: maybe 2.5 FTEs in the practice, full-time equivalents, GPs. We had the conversation and this guy says to me, yeah, I'm buying it for somewhere regional, maybe a 4-room, 5-room building plus the practice. And I think the building was maybe 800 or something like that. And then the price of the business was something in the region of 1.8 million.
Right.
Now,
Wow.
just saying those words sounds silly, which is why I was choking on my words a minute ago. How do we get into that situation, Todd? Like, how does that happen that they're ready, but not just ready? The bank had said yes to lending them the money for that deal as well.
Yeah. So the trick that's pulled for this is a really common one. Let's use that example. So there are 3 GPs there and selling the business, and let's say each GP is doing kind of a little bit above average and billing $500K each, right? So the billings for the business would be around about $1.5 million. And Australia-wide, I think when they do the benchmark of the average margin based on the billings, it's about 8%. So that would mean that business had a profitability of around about 100 to 120 grand. Being rural, I would have some concerns about that. It may not be true. It may be that because it may be getting the right staff is more expensive, particularly if miners locally are competing for the staff and all those other things. But let's just keep it really simple and say that the earnings are $100,000. A business of that size probably should have a multiple of around about 2 to maybe 3 times. Let's pick the midpoint, 2.5 times. So you're probably paying $250,000 a business like that, thereabouts. But the way they scam it is that the two doctors, often they're partners that own it, life partners, and so they're billing $1 million between them. Let's pretend that they decide, you know what, we can live off 250 grand. So rather than actually engaging as a regular doctor with a service and facility agreement and taking home, say, around about 65%, so ordinarily the $1 million they build, they would be keeping 650K. The service fee entity gets 350. What they do instead is they say, actually, we can live on 250. So they leave 750 in the service fee entity. And in doing so, they bolster the profit. And I'm going to use inverted commas here if you're listening to this, because it isn't real profit. It's actually their personal exertion income that they've retained in the business for the purpose of inflating the profit. And so this business now looks like it has a profit of $600,000 or maybe $700,000 or thereabouts. And this is commonly done by these scam merchants, I'll call them what they are, because they just purely trying to make out that this is something that it isn't, because clearly that profitability leaves when those doctors leave. So the other thing they often do is those doctors are usually leaving within 6 to 18 months because they know that in a short period of time, the person who buys it is going to be very pissed off about what they've actually bought. And on the other side of this, it's really unpleasant for everybody. So they falsify the earnings so that they would look like they're something of the order of $800, maybe $900,000. And then they're selling it at 2 times earnings. So they're saying, hey, this is a bargain for you, because usually these businesses would go at 3 to 4 times earnings, which may be true if the proper earnings were $400,000 or $500,000. And so these people end up buying something at a price that is often above the turnover of the business on a billing level. And it will never, ever, ever achieve that output. And so they've bought a practice as well with it, which has often got 4 rooms, maybe 5 rooms. So the 2 key doctors that are part of the billings leave. This person's left with an absolute millstone. They've got a building that they can't hope to use for an alternative use. They can't fill those other rooms. And then they've paid way above the odds for a practice. And the thing that shits me the most with this is accountants in particular that are unprofessional. So this is professionalism over professional. So I don't have any problem with professionals, and accountants are a really important part of your advisory team, but people that don't know what they're doing have no place advising on the purchase of these businesses. And there are repeat offenders out there that do this quite regularly. And then the bank, of course, says, yeah, we'll give you the money, because the bank cares about serviceability. Because what happens when your practice falls over, they don't give us stuff, they'll just take your house. So your family home's gone, and because you know that, then you're prepared to work extra in order to pay off that sort of 150 to 200 grand a year of loan debt. You're going to have to just work extra hard to make sure that you do that. So what you're sacrificing in the end is the vendors get something. They get to sell their business for a well above market rate. They exit pretty soon after because they know that it's not a reasonable purchase. They would never report it for that. And then the only one who wins out of it is the accountant, who usually got paid for the special advice and maybe the transaction accounting work. And then the bank, who gets to have you paying back debt that ultimately is on nothing. There's no underlying asset that underpins the value of that. So normally you'd rely on an asset going up in value over time. In fact, from the moment you transact, this is probably worth something like 10 to 20% of the actual value you transacted it. So you've got a loan of 80% of that business purchase price that is worth nothing, that will take you 10 to 15 years to pay off. And what you sacrifice in return is your mental health, your relationships, because you will not get to spend time with the people you care about. Doesn't matter if it's family or friends. And you will almost always sacrifice your health, because your mental health does not respond well to being taken to the cleaners. And you don't have time to do any physical health. You forget going to the gym, going for a walk. You are booked into that clinic from 8 a.m. until 7 p.m. and that's it. And then the worst thing is, those people often think, you know what, because I've been screwed, I need to go and make a lot of this money back, so I might invest in Bitcoin or all these other speculative investments just to try and win it back. And it's super frustrating to watch,
and I think, obviously you're more of a skeptic than me. And so the place I've seen it play out is literally advisors who don't have a clue. They're not familiar with the industry. And so they've set practices up to operate like this, where the owner, whether it's a couple or even if it's an individual, all their billings go into the service entity, and then it artificially inflates the apparent earnings of that, the profit. And so even sellers I've seen get a raw deal here because they thought they were doing the right thing by taking the advice of this person that helped them set things up from the beginning. But actually, and they thought they had a nest egg they're sitting on. But when they get found out, it's actually a potential that someone loses in this situation. Like it's either the seller or the buyer loses. And it's rarely that both lose, and very rare in these sort of setups where both win, where both are happy with the deal. And so I think what you're saying is essentially someone who sort of participates and completes a transaction like this is really buying a very, very, very expensive job. Yeah. And they're buying
if they're
that
lucky.
in terms of with money, with time, with their soul's energy, but it's avoidable. And so you talked about professionals and the importance of professionals. How could someone who's in the midst of buying or going through the due diligence process when they're assessing, they've been told a price, and sometimes you may have been working somewhere and thought, oh yeah, they've just told me the price. I'm just going to, yeah, that's fine. I don't have this dirty conversation about money. I've worked here. I trust the place. I'm just going to pay what's necessary. I have faith. It runs well. I know it. How could someone avoid some of these pitfalls that we've talked about, both through the professionals they use and maybe some of the briefings that they give those professionals? Like what questions and discussions and with whom should we be having when we're at this stage in our ownership journey?
Yeah, I think it's a really good way of looking at it. And the first thing is that you need to choose your professionals wisely. So make sure that you consult widely with your colleagues that are also owners as to experts in this field. If I was going into buying an engineering business, I wouldn't use my existing accountant to advise me on that. I'd make sure I got somebody who is an expert in that field. And I think the other thing that we do a lot in medicine, but we don't do a lot in professional standards, is actually getting second and third opinions. Ultimately, this is a really large purchase. Let me be really clear. If you screw it up the first time, you're probably setting yourself back a decade, maybe 15 years. You may never buy another business again because you're so scarred by the interactions and the consequences that you don't ever do it again. So this can knock you back a long way in your investing and just your commitment to your family for the things that you thought you'd be creating. You often think, oh yeah, I'll get some time freedom, we'll get some business profit, you'll get to build a great team, I'll have time away from the business, we'll go on holidays. All of those things call off the moment that you've bought into a business that's a low quality business. And then, Sachin, we'll get to the briefing in a moment, but there's a really good framework from one of the guys that we love, Keith Cunningham. He's got a great book called The Road Less Stupid. And he has 4 questions to ask yourself. Number 1, what's the upside? We're good at that because we're usually entrepreneurs tend towards optimism, and the upside is the reason why you want to buy it in the first place. Number 2, what's the downside? Number 3 is really important. Can I live with the downside? Now, you probably need to speak to somebody who just says, tell me all the bad stuff about this. That can just give you a list of all of the problems, because there can be confirmation bias here that you tell yourself the story you want to hear because you really want to be, you identify as somebody who owns a business and you see this as the one that is the business for you. And then question 4 is super important. This is, what is it I don't see? And this, you definitely need somebody else's perspective. And so this is where having a second or a third accountant look at this, somebody else who's a business expert who can say, no, this is a scam and this is the way that this is done. Because it's easy to say no to these deals. If you're doing this well, saying no to deals regularly is a good thing, and paying money to not do a deal is a good thing. So one of the things that buries people is the sunk cost fallacy. So they think, well, I've spent 20 grand getting advice on this deal, and so the one thing I don't want to do is waste that 20 grand and not go ahead with the deal. Now, I looked at 3 clinics before I opened my first one. Went through the analysis on them, and they weren't purchasing other clinics, but they were all on analysis, and said no to 2 of them before I actually went ahead with the last one. And it's frustrating when you're paying all these experts and you don't have an outcome for it. But what you do have is you did not proceed on a pathway that was a danger path and it was likely to harm you. So make sure you get second, third, fourth opinions. In fact, as long as they're from experts, getting more is better than getting less. I think that's really important. And then one of our favorite sayings in Project X, where we do our work with owners, is the quality of the brief determines the quality of the answer. So as well as hiring crappy experts, people that don't really know what they're doing, asking dumb questions will get you dumb answers. Like people who say there are no dumb questions, there are heaps of dumb questions. Don't ask them. You need to give people a really good quality briefing, and it needs to include what happens if, what happens if, what happens if. If you go and buy something that doesn't have genuine business income, what you're actually ending up with is huge key person risk. Guess what happens if you fall over? Your family is liable for these debts. That's not a good outcome. You need to ask the question, what happens if, what happens if, and explore some of the things that are less pleasant, but you do need to know the answer to these. You've taken on a huge financial commitment and it doesn't have an asset underlying it. That's a big deal. That's a scam.
Absolutely. And so you've given us those questions, and I'm thinking that those questions are probably also questions that we could ask of our advisors. From your perspective, what's the upside of this deal? What's the downside of this deal? What are the ramifications of the downside? And what am I not seeing that you can see as an expert? And then I think one of the things I've learned since we've worked together, Todd, is that pausing and taking second and third opinions. And I think you have a trick that you ask them to deliberately be contrarian to your first advice. Can you talk a bit about that?
Yeah. So one of the things, in order for you to understand where you sit on a spectrum of advice, yes, no, and all of the little spots in between that, it's really important to go and pay an expert that holds a contrarian view. So I remember doing this several times with structures in business, and there was a view that you should structure things in a certain way, and somebody had the opposite view. So I'd actually just go and make sure that I found the person who was most dogmatic on the opposite view and went and paid them for advice, because ultimately it's you're the one who's accountable for whatever advice you take. You can't say, oh, well, I was told. That doesn't make any difference. You're the one whose signature is on it. And you need to weigh up yourself what the relative pros and cons are, because it's not usually really clear which advice should be taken. The reason there's a spectrum of advice is because it depends on the context. And so you need to understand the context really well, and you need to understand the content. What is the content of the advice? And then you need to make a decision that suits you and understand if that's just something that suits you now or in the future as well. And so all of these decisions must be made by you. And so you should invest heavily in getting expert advice, particularly advice that is disconfirmation. So it's really easy to get advice that confirms your bias. I reckon this, I'm going to pay these people to give me the advice. That's not that valuable. The advice that is disconfirmation, that actually counters your internal biases or preferences, is by far the most valuable advice. Just get it from experts and make sure you go in with a good briefing and you understand the framework for all of the questions that you're asking. And ideally you share it in advance and just say, I'd like to spend 1 or 2 hours, whatever's the appropriate allotted amount of time. The other bit of advice I'd say is never do this in a free consult. You should always pay for this advice. Don't try and get this advice for free, because one of my other favorite sayings is, if you think advice from experts is expensive, you wait until you pay for amateurs. So you just want that person to want to take your call and to work with you again in future because you take your advisory seriously. You want to make sure those people are always paid for giving advice. They get a good briefing on the front end. You've got a clear budget, a clear amount of time allocated, and you've got a clear output. Is it a report? Is it just a meeting? What exactly comes at the end of that? And then the more you do this, the smarter you get, because you'll incorporate that knowledge in your future interactions.
And so what sort of advisors are we talking about? Like, who should I choose if I'm buying a general practice? Which advisor should I choose?
Yep. So there's 3, I think. The first 2 are obvious. You need an accountant, and the accountant cannot work for the vendor. So to be clear with any of these advisors, they should never be conflicted. So you can't take advice from the accountant or the lawyer that are selling, that are acting on behalf of the vendor. I've seen people do this, and it's an absolute disaster. I don't know why people would think that's okay on both sides. So you need to have independent advisors. You're going to need an accountant. Ideally, you have an accountant that is the accountant for the business, and you probably have a different accountant that's personal. That's a useful sort of check and balance. and then you would need a commercial lawyer that's going to help with the transaction. That person may have somebody else in the firm that does your personal stuff, be that conveyancing or any other legal matters that you need to have attended to. So those two are important. The other one that people don't usually focus on is people like us. So you want people that have been around and know the tricks. So I've seen tier 1 and tier 2 legal firms and accounting firms certify actions that were, I'd like to say a word other than this, but they were probably criminal actions. They were scams. And the reason they did that is they did not have familiarity with the area. And so they just basically certified that the money that they said was going to be paid was paid, that it all came in. But actually, anybody that knew the sector well would know that these were fraudulent transactions because they didn't make sense. Like they weren't, that the quantity was abnormal, the volume was abnormal. So you need bullshit detectors in this stuff. We don't do this advisory in Project X, so we don't do purchase advisory for people that are working with us. We help them prepare their business for sale. And so it's not easy to get advice from actually you and I, and I'm just going to say bad luck. We only work with people in Project X, but you do need to find people like us that you can talk to about it, because you need to find out what are the ways that people are looking to scam me and what are the tricks, where are the bodies hidden in the financials that have been given to me, the cash flow statements, the profit and loss. And one way to mitigate that is to have experienced people in the legal and accounting advisory, but you do really want people on your team that have been experienced, have been there before. I'll tell you the main thing that puts people off is I reckon people think I've got this great deal, I don't want to tell anyone about it. I reckon that's what's on their mind, as if you're going to rush off and buy this rural practice or this unusually valued property and practice combined. The reality is, if you want advice, you've got to share the projects you're working on. You can always have a non-disclosure agreement or make sure that there's something appropriate that binds people to privacy. But yeah, paying for good advice and paying well for that advice is a really important habit of successful people everywhere.
And I think the key thing that you just mentioned is people who have a track record in the particular industry you're buying or transacting in, because they just have more knowledge that's relevant to that particular arena. So talking about experience, obviously we don't work with people when they're buying in Project X unless they're already working with us, but we can share our experience here. So what are some red flags that people who are thinking about buying should be just extra careful about? And then maybe we'll share a couple of case studies or examples of things we've seen.
Yeah, so I think that's a great question. I think one would be where it's a hurried sale and there's the idea that there's other invisible buyers and the process is murky. That's probably one. Where there is a combined property and business sale and the individual value of either is unclear or not verified by other sources. Not having multiple years worth of financials is something that would concern me, because it suggests that they may have been reshaped. Being encouraged to use the same accountant / legal person that is part of the sale would also be a red flag for me. One thing I think, Sachin, a question they should ask themselves is, given that I was able to start up near this practice, how long would it take me to build this thing of this value and how much would it cost me? So when you're buying a business, often people forget that they're really buying time. They're front loading it. So if you think, geez, this would take me $1 million and 5 years to achieve, then it has a value of beyond $1 million because you're buying that 5 years. That's what you're actually buying, as well as the income stream, which is needed to fund the loan. And then on the back end, I think people need to be asking better questions of their financiers and just making sure that they are actually evaluating this on the basis of the financial performance, not something else. Because in many cases, it's not on the financial performance, it's based on their assets. And so what we've found a couple of uncomfortable circumstances where people have actually had to forcibly liquidate their assets in order to address the imbalances in these loans. That's not a lot of fun. You might have had something you've owned for 10, 20 years. That is a way that you created wealth, and that's all destroyed in one silly transaction.
There's some great red flags there. The ones I've also seen, that I would probably add to that, is you've talked about income inflation by, for example, putting the whole of the revenue generated by owners into the service entity, so it seems higher than it is. Obviously, there's the ability of non-compliant work as well that could inflate income. There's also an expense side situation that I've come across, or a few, often to do with situations where certain key employees are employed separately from the seller's separate entity or another place. It's not on the P&L, and so the P&L is artificially high.
So there's a marketing function or a practice manager that's maybe someone in the family or somebody who's related party that the money is going from somewhere else. And so it looks like those jobs are being done, but there's no accounting for them in the cash flow.
That's a common one when families are involved. And it may look like that for the last 3 years or 4 years or 5 years because people have thought ahead and they know for every 100 grand that doesn't show up on the P&L, there might be 2, 3, 4, 500 grand of valuation that comes back. And so I think all of this is relevant to sellers as well who might be listening to this, or people who are thinking of exiting in the next 1, 2, 3, 5 years. If you're set up in this way where it is artificially inflating the value of your business, then you've still got time to go and get that right, set up right, and then make your business better so you do get a good payday when you sell. So if you're a seller here, I think the vast majority of people are decent people, and so not willfully trying to scam others. However, temptation must arise if you've worked 30 years plus, thinking you're building a $2 million asset, but it's only worth 200 grand. Then your belief takes over that, oh no, I deserve this. And so I think no one would want to willingly and knowingly put a colleague in distress, but you could be doing that. If you want the 2 million, build something that's worth it and then get your payday. Cool. I've got another question then, Todd. Let's talk about a few examples because we can then illustrate the types of things we've seen. You alluded to a little bit of one earlier, but it would be great if you've got an example or two, and I might have one or two.
Yeah, there's probably a few that come to mind. Some of them are a small clinic, and whether it's rural, urban, doesn't really matter that much, but probably somewhere between 2 and maybe 3 GPs in total. And sometimes the person buying the clinic, the purchaser, is already working there. So they're actually, to a large extent, buying the business that they're already substantially creating. And so they should be asking themselves, what would happen if I kind of started myself? What would be the cost of doing that? And these businesses typically don't have much upside. So the environment that they're working from is often only 3 or 4 rooms. And I would argue that a smaller clinic probably has less value anyway, in that it doesn't have a lot of growth, and therefore cost containment, cost controls are really important, and room utilization becomes important. And so these ones often have an owner whereby they're retaining 100% of their billings in the service entity, and they're basically living off whatever's left over and calling that the profit. And so that's probably the most common thing where people you want to make sure that every single doctor, every single earner is engaged as an independent GP, and that they have a service and facility agreement, and that they retain whatever that percentage is. Most commonly it would be 65%, and it should only be 35% that then goes into the real revenue, the trading entity. And so that's probably the number one thing where people inflate the value of this. And I think this happens because people don't have any concept of what the value of a business should be. They haven't looked on the marketplace. They don't have any comparators. And so that's an issue. So the small one is one. The other one that I find a big issue with is where the vendor owns the property and the business, and they either bundle the sale of both and inflate the value of both because they kind of lack any independent valuation, and the buyers have neglected to do that bit of work. So that's an important one. And even worse than that sometimes is where they give them the right to purchase the property, but they rent it initially, and we've found substantially above market rents. So one comes to mind that was in a rural setting, a pretty well-run doctor. Their doctor bought it for multiple hundreds of thousands of dollars and then paid a well above market rent with the possibility of buying the property. The property wasn't really fit for purpose, so they'd overpaid for an asset that was probably worth zero, to be honest. And then the rent was probably more like half of what was being paid, and it shouldn't have been a long-term rental. The property wasn't fit for purpose. So in the end, this person had to go and set up, build their own practice, do all of these things again, and go and recreate all of these values. And in fact, they would have been better to do that right from the start, to set up their own practice nearby. These are often people near retirement age. So some people feel an obligation to serve doctors that are retiring or leaving. And so that becomes a part of the challenge, I think, in this circumstance. You probably have one to share too, Sachin.
One of the classics is someone who bought the business off the previous owner, and the owner retained freehold of the building. but then had just cut a new lease with their original business that they were selling at a significantly inflated rent. And so the person bought the business, the buyer, the vendor retained the property, almost a double market rent. But because the profit seemed bigger, it all seemed okay. But actually, they'd done both. The profit included the seller's billings, so it was inflated.
Right.
And then that was used to hide the inflated rent. And so this person, once they bought the practice, suddenly couldn't make the rent and they couldn't understand why. But with a little bit of unpacking, they realized they'd been done on the P&L, on the profit, and they'd been done on the lease being double, but they were stuck. So that's one example. The other is one in Melbourne, or given the city now. I haven't been involved in this. I just saw it. It came across my desk. It was, I think, 3 rooms practice. There were family members involved in running the practice. Like more than one income generator was family. And when I looked at it, the price, I think the asking price was 1.8 just for the business, 1.8 mil.
Right.
And then I looked at the P&L and it was about 500, 450, something like that profit. And then I looked at where those billings were coming from. And it was the classic, the principal, the owner, had put all of their billings into the entity. Maybe there was a preferential service fee percentage in terms of higher service fee shown by the family member as well into the service entity, not partner, another family member. And so there was inflation of the profit and loss based on that. And so the price was justified using that. What I was surprised about was that this came across to me from a business broker with track record in the medical sort of field. And that was surprising for me that the person wasn't told that, hey, like, what are you thinking of asking? Like, how can you think of asking for this? So what that just tells me is what you were saying is that you have to ask the right questions and have the right brief for your advisors, because I would have thought in this situation, a reputable, well-known business broker would have said to the owner, I think this is wildly off.
Yeah, and so people treat that as a type of endorsement and validation.
And then the banks at the moment, it's relatively simple for a doctor owner to pick up 100% borrowing on up to, say, 3 million. And so in the example I just gave, Todd, it's pretty much a $7-figure $1 million mistake. What are the long-term consequences, or near, medium, and long-term consequences of that type of mistake?
There's a few things I think, Sachin. The first one is when you realize you've been scammed, you've got a choice to make, right? And so we've talked to some of these people that have made these choices. They don't have a lot of resources because they've been misled. And so their repayments are higher than the business anyway, because they've now got debt in that business that needs to be paid down. And also the business is often performing substantially less than they were led to believe. And so they're trying to make a decision about, should I undertake legal action with diminished resources, which may actually push me to the point of failure. And that can mean a lot of different things. So that's one thing. So typically they don't pursue it as they should because they lack the resources to, because they're tied up in keeping the bank happy. They don't want to fall afoul of the bank. That's the first thing. I think all those things we talked about earlier, what you sell, the only way you can replace this is by getting your backside into gear, working doubly hard. That's the biggest problem, because the one way that you make up for this is working an extra 10 or 20 hours a week. And that's a lot of money. That isn't going to you. It's just going to your mistake fund, your error fund, your dumb tax. And so that's a big deal. And then I said the consequences earlier, but their personal health, their mental health, and they're your relationships. They're the things you sacrifice in that. And also fundamentally, sometimes people's relationship with business are damaged because they'll walk away thinking, I'm no good at business. I can't do business. I'm hopeless at this. But actually they're just scammed by somebody and they had really poor advisors. And so it can take people a decade to work their way out of this. The reality is, once you're in it, and you've made a call not to legally pursue rectification, you have to work hard on getting it right. And that's when you probably need advice as well. So the reality there is you probably do need to spend some money on getting advice in making sure that you absolutely nail execution, because you can't afford to learn slowly and you can't afford to make mistakes. And people sometimes do those things when they have a lower outgoing, lower commitment. When you've got all those things committed, you need to get smart really fast. And so that's where the likes of working with us or somebody like us comes into play. And then the biggest way to pay it off is over time, reinvest those mistakes in doing it again and again, but the right way, so that you build a bit of an empire to diminish the cost of the earlier mistake. That's probably the key way, I think, Sachin.
And probably the best way is get in a time machine, listen to this podcast, make some notes, discuss every little piece with your advisor, and then act on that advice. And if you're going to be committing 1 million, 2 million, maybe it's a bit less, maybe it's a bit more, whatever that number is, it will cost you a fraction of that, like single-digit percentage points, to get multiple pieces of advice and deliberately provoke the advisors to find and give you contrarian points of view so that you can make a fully informed decision and you're not spending the next decade of your life, your family's time and energy and enjoyment of you paying back for a mistake that could have been avoided. Todd, that's been excellent. Appreciated. If you have just bought or you're in the process of preparing your practice for sale, you know where we are. We are here to help. It's really important to us that all general practices owned by private non-corporates do well. We want them to do well in the right way. And the right way is the right structures, and the right setup, the right systems, the right processes. With that, we can build thriving practices that generate true value. And then those deserve to be sold at a premium. And those deserve to be bought at a premium and then made even better by the buyers. That's the group we're here for. You know where we are if you need us. Take care. Bye-bye.